Welcome back to the deep dive. We're here to cut through all that noise and really deliver the insights that help you get properly informed. There's just so much data out there. Our mission is simple: find those aha moments fast. And today we are taking a deep dive into a company that, well, might just be flying under the radar a bit. AAR Corp. That's NYSE, ticker AAR.
So here's the big question we're tackling.
Yeah.
You've got the entire airline industry hitting, unprecedented turbulent supply chain nightmares, massive backlogs at the big manufacturers. Could a, 70-year-old aftermarket specialist like AAR be the kind of secret pilot that guides your portfolio to, well, significant outperformance?
That's exactly the question. In this deep dive, it's really a value investor's look at ARR Corp. We're anchoring everything to today's date, June 18th, 2025, and using that share price from June 13th, which was $68.63. We'll be looking at, what makes them tick, the challenges they face, and some pretty significant opportunities, too. Okay, great. But before we really get into the weeds here, just a quick reminder, if you're finding these deep dives useful, please do like and subscribe to the Stock Analytics AI YouTube channel. For just $4.99 a month, members get priority access to deep dives on specific tickers, and you can even suggest stocks in the comments for us to look into.
Good point.
So yeah, stick with us. By the end, you'll have a much clearer picture of whether the market might be, well, missing something here with AAR, and if its intrinsic value paints a different picture than that $68 share price. All right, let's get started. Chapter 1. Business analysis. Okay, first things first. To really get AAR, we need to be clear on what they don't do. They're not an airline, or they're not a manufacturer like Boeing or Airbus.
Exactly. You've got it. AAR Corp is fundamentally a service provider, a critical one, actually. They keep the world's planes flying. Think of them as a global aerospace and defense aftermarket solutions company. So not the car maker, but the expert mechanic and the part supplier for planes already in service.
Right, the aftermarket. And they've actually streamlined how they operate recently. Fiscal 24, they realigned things.
Yeah, they did, into 4 main segments aiming for more clarity.
Okay, so the first one is parts supply. This sounds like a big one, almost 40% of sales, and it's got sort of 2 engines driving it.
That's a good way to put it. Yeah, part supply is huge. One engine is distributing new parts. They have these exclusive long-term deals with manufacturers, and apparently the renewal rates are near 100%.
Wow.
The other engine, and this is really interesting, is USM, used serviceable material.
USM. Okay, tell me more about that.
So AAR is actually one of the world's biggest providers here. What they do is they buy up used aircraft, carefully take them apart, and then they refurbish the components. These parts are fully certified, safe, but they can sell them at a 30% to 70% discount compared to brand new parts.
30 to 70%. That's massive savings for airlines.
Huge. Especially when getting new parts can take months because of those OEM backlogs we mentioned. It's a critical solution for cost and time.
Okay, so parts supply is key. What else? There's repair and engineering.
Right, that's their MRO business. Maintenance, repair, and overhaul. Think heavy airframe checks, fixing components like landing gear, that kind of thing.
Yeah.
And they even have their own proprietary PMA parts manufacturer approval. It's another way they offer cost savings beyond just using OEM stuff.
Interesting. And then integrated solutions. That sounds broader. Logistics and tech.
Yeah, exactly. This covers things like managing entire fleets for customers. Like the U.S. Department of Defense, they do these power by the hour deals too.
Power by the hour.
Yeah, basically the customer pays based on usage and AR takes on the maintenance risk. But crucially, this segment also includes the Trax software business. They bought Trax in 2023. It's an ERP platform specifically for aviation maintenance, and it's high margin, a really key differentiator for them now.
Okay, got it. And the last one is smaller. Expeditionary services.
Yeah, that's non-core, really. Mobile shelters, special cargo systems, often for defense or maybe humanitarian stuff.
So it's a pretty diverse setup. They can make money at lots of different points in a plane's life.
Absolutely. It's comprehensive. And they've got the scale to back it up. We're talking nearly 6,000 employees, over 60 sites globally in 20-plus countries.
Serving thousands of customers worldwide.
Yeah, 2,300 customers in over 100 countries. And importantly, they're the biggest independent MRO provider in North America. That scale matters.
So their core value proposition boils down to what?
It's pretty simple but powerful. Cost-effective, reliable, and timely aftermarket solutions.
Yeah, I can see how timely is huge. If an OEM tells you a part takes 6 months and AAR can get you a certified used one overnight, That's incredibly valuable.
Makes them an essential partner, really, for airlines, for leasing companies, even indirectly for Boeing and Airbus by keeping the whole ecosystem running.
And the timing seems perfect for them right now with this industry supercycle.
Well, yeah, the conditions are incredibly favorable for the aftermarket sector. Those OEM backlogs are unprecedented. Boeing, Airbus, they're sold out for years. Airlines just can't get new planes fast enough.
Which forces them to keep their current planes flying longer.
Exactly. And older planes, naturally, need more maintenance, more parts. It's simple logic.
And the market growth reflects that.
Absolutely. The global MRO market, it's projected to grow from maybe $90 billion now to $155 billion by 2034. That's a 6.2% compound annual growth rate.
And aftermarket parts even faster.
Yeah, parts are forecast around 8.0% CAGR through 2032. These are strong, sustained tailwinds.
Plus their government business has stable funding too, right?
Right, supported by high defense spending. It adds stability. Now, the competitive landscape is fragmented. You've got OEMs doing their own aftermarket, other independents.
Peers like Triumph Group, Kratos.
Hexcel, Spirit Aerosystems, yeah, those are some publicly traded ones.
Yeah.
Here's a really key point we need to flag.
Okay.
If you look at AAR's trailing 12-month GAAP net margin, it's negative, minus 0.46%.
Negative. That sounds bad compared to profitable peers.
It looks bad on the surface. But stick with us. Chapter 3 will explain exactly why that is and why it's actually down to specific one-off events. The underlying business is healthy.
All right, looking forward to that. What about getting into this business? High barriers to entry.
Extremely high.
Right.
First, it's intensely regulated. Think FAA globally. Compliance is everything. AAR was actually the first independent MRO accepted by the FAA for its Safety Management System program.
So regulations are one barrier?
Huge one. Then there's the capital intensity. You need billions to set up the facilities, inventory, global network, and finally reputation and relationships. Building trust, proving reliability, that takes decades. AAR's been doing it since 1955. You can't just replicate that overnight.
Okay, so strong barriers. What about their specific competitive advantages, their moat? Brand is one.
Definitely. They're doing it right. Trademark isn't just marketing fluff. In aviation, 70 years of quality and reliability means a lot.
And scale. Being the biggest independent MRO in North America must help.
Immense cost advantages, better purchasing power, efficient operations. And their leadership in USM gives them a structural cost advantage they can pass on.
Network effects too, maybe, with all those global sites?
Yeah, supporting customers globally creates value. But the real kicker for switching costs now is that Trax software.
Right. Once an airline builds its processes around Trax.
Migrating everything, maintenance schedules, inventory, compliance tracking to a different system, it's incredibly complex, expensive, and risky. That creates really sticky recurring revenue.
Makes sense. And other unique assets.
Those exclusive OEM distribution deals are huge. Near-perfect renewal rates show their value. Their deep expertise in sourcing and certifying USM parts is hard to copy. And the Trax platform itself is a valuable IP asset, a high-margin differentiator.
Okay, that gives us a really solid understanding of the business itself. Let's pivot now and look at the people running the show. Chapter 2, Management Evaluation.
Right, leadership. AAR has a pretty seasoned team. The CEO is John M. Holmes. He's been CEO since 2018, chairman since 2023, but he's been with AAR since way back in 2001, so deep operational knowledge.
And the CFO.
Sean M. Gillen, CFO since 2019. He brings a strong finance and M&A background, which seems, well-suited to their recent strategy.
Okay, but they faced a major test recently, didn't they? That Foreign Corrupt Practices Act investigation.
Yes, the FCPA issue. That was definitely their defining challenge. It resolved in late 2024, cost them over $55 million in penalties. A big number.
So how did they handle it? What does their response tell us?
Well, it's a bit nuanced.
Yeah.
They did self-report back in 2019 and apparently didn't get full credit because some media articles had already surfaced. However, they did cooperate extensively and put remediation measures in place quickly, enhanced compliance, this compliance champion network.
Right.
And that earned them a 45% reduction from the sentencing guidelines. Critically, they secured a non-prosecution agreement in MPA.
Which is better than a guilty plea.
Much better.
Yeah.
Especially for a company relying heavily on government contracts. An NPA was vital. It suggests they took it seriously and are committed to fixing things.
Okay. And how are they on communication, transparency?
Reasonably transparent, I'd say. Filings, earnings calls.
Yeah.
They seem pretty open. That strategic realignment into the 4 segments also helps with clarity.
But their ethical reputation must be rebuilding.
Yeah, rebuilding phase is a good way to put it. They're saying the right things, taking action, but trust takes time to rebuild after something like the FCPA.
What about how they're allocating capital? Where are they putting the company's money?
There's a very clear, disciplined focus here, shifting the portfolio towards higher growth, higher margin activities.
We saw that with the acquisitions, right? Trax Software, that Triumph component repair business.
Exactly. Both aim squarely at higher margins and getting more intellectual property. And at the same time, they're selling off other bits, like the landing gear overhaul business, which presumably didn't fit that high margin profile.
They're investing organically, too, building new hangars.
Yep. Big expansion projects in Miami and Oklahoma City. They expect that to boost their MRO network capacity by about 15% by fiscal 26. They're clearly positioning to grab more of that booming MRO demand.
Okay, now, shareholder returns, dividends, buybacks.
Dividend's been suspended since COVID hit in March 2020. Hasn't come back.
So they're choosing reinvestment over dividends.
Clearly, it signals a deliberate choice. Prioritize growth investments, acquisitions, and paying down debt rather than immediate payouts. They did start a $150 million share buyback program in fiscal 22, but the main focus seems to be strengthening the business and the balance sheet.
Makes sense strategically, maybe. How's that translating into efficiency? Return on invested capital, ROIC.
ROIC is a key metric here. It recovered really well after the pandemic lows went from like 2.5% in FY20 up to 8.0% in FY23.
But it dipped slightly in FY24.
Yeah, dipped to 6.7%. That's mostly because the denominator of the invested capital shot up after they took on debt for that Triumph acquisition.
So the challenge now is
generate enough profit from that bigger capital base to push ROIC back up again. Their success or failure in doing that will really show if the strategy is working.
Okay, makes sense. Now let's get into the nitty-gritty of the numbers. Time for the financial deep dive. Chapter 3, Financial Analysis.
All right, financials. Starting with the basics. Market cap is around $2.45 billion. Puts them squarely in the mid-cap space for aerospace and defense.
And revenue growth, you mentioned the recovery.
Yeah, it's a tale of two halves. Post-COVID, a sharp drop, down over 20% in FY21. But then a really powerful rebound. FY24 revenue hit $2.319 billion, up 16.5%, and the trailing 12 months, even stronger, over 21% growth.
Okay, strong top-line recovery. But what about profits? Those margins, you said GAAP was misleading.
Absolutely crucial to look past GAAP here. Gross margin has been improving nicely, from 13% up to over 19%. But the real story is the adjusted operating margin.
Adjusted, okay.
That's where you see the strategy paying off. It shows consistent, impressive expansion from 7.5% in FY23 up to 9.7% in the latest quarter, Q3 FY25. That validates this shift to higher margin stuff like Trax.
And that explains the negative TTM GAAP net margin we saw, the negative 0.46%.
Exactly. That GAAP number is entirely driven by those recent one-time hits.
Yeah.
The big FCPA settlement payment and a $63.7 million pre-tax charge from selling the landing gear business.
So fundamentally, the underlying operations are profitable and improving.
Very much so. You have to adjust for those non-recurring items to see the real picture.
What about cash flow? Free cash flow.
That's been inconsistent, mainly due to working capital swings and those one-off payments. Like in Q3 FY25, they reported a cash use of nearly $19 million.
Which sounds bad.
But that included the $56 million FCPA payment. If you back that out, their underlying cash generation was actually positive. Again, need to look under the hood.
And earnings per share. GAAP versus adjusted. Same story. GAAP EPS is inconsistent because of the charges. But adjusted diluted EPS shows a much clearer positive growth trend. Went from $2.38 in FY22 up to $3.33 in FY24. That's a better reflection of core performance.
Okay, so core operations look healthy despite GAAP noise. What about financial stability? Debt.
Debt's definitely something to watch. Their debt-to-equity ratio is around 1.41 now. It jumped significantly after they used debt to buy Triumph. Management says debt reduction is a key priority.
But they have enough short-term liquidity.
Yeah, their current ratio is very strong, actually, around 3.0. That indicates they have plenty of liquid assets to cover near-term obligations, which is reassuring given the higher debt level.
And dividends still suspended.
Still suspended since March 2020. Again, deliberate choice. Reinvestment and debt pay down over dividends for now.
Okay, let's talk valuation. The TTMPE is useless because it's negative.
Right, so we look forward. Based on analyst estimates for FY25 adjusted EPS, around $3.75, their forward PE ratio is about 18.3.
How does that compare? It's kind of mixed compared to peers. Some are higher, some lower. It doesn't scream obvious undervaluation or overvaluation on its own, which is why we turn to intrinsic value.
Right, the discounted cash flow, or DCF analysis, estimating value based on future cash flows.
Exactly. The idea is a company's true worth is all the cash it can generate for its owners over its lifetime, discounted back to today's value. It's a more fundamental approach than just looking at PE ratios.
So what do the educational DCF models suggest for AAR?
Looking at a few sources, Simply Well Sent, Moo, Alpha Spread, plus a more conservative model, they consistently point to an estimated intrinsic value range of roughly $90 to $120 per share.
90 to 120, compared to the current price around $68.
Precisely. Now, these are educational estimates, not precise predictions, and they depend on assumptions.
Key assumptions being
Future cash flow growth, usually based on analyst consensus, maybe a 2.8, 2.9% terminal growth rate. And the discount rate, typically around 7.6, 8.0% for AAR, reflecting its risk profile. Its beta is about 1.126.
Okay, so the core of the value investment argument here is that substantial gap between the current share price and that estimated intrinsic value range.
Exactly. It suggests the market might be too focused on the temporary gap losses, the debt, maybe the FCPA hangover.
And potentially overlooking the strong underlying business, the positive tailwinds, and the long-term cash generation potential.
That's the thesis, yes.
All right. Fascinating stuff on the financials and valuation. So we know what we think looking at the numbers, but how is the market actually perceiving AAR right now? Chapter 4, Market Sentiment.
Well, if you look at Wall Street analysts, the sentiment is distinctly bullish. The consensus is basically buy or strong buy.
Yeah.
You don't see any hold or sell ratings among the analysts covering it right now.
Really? Unanimous buy side? What are their price targets saying?
The average one-year target falls somewhere between $79 and $80.20. The high target goes up to $86. Even the lowest analyst target represents pretty meaningful upside from that current $68.63. So the specialists seem convinced there's value here, looking past the short-term noise.
Okay, strong analyst backing. What about news flow? General media tone?
That's more mixed, I'd say. You see positive headlines about strategic wins like landing Delta Tech Ops as a customer for their track software or a new supply chain deal with the Defense Logistics Agency. Good stuff. But the shadow of that FCPA settlement still lingers in some reporting. So overall, the news sentiment feels kind of neutral to maybe slightly bullish. Not overwhelmingly positive, not negative either.
Okay. What about market indicators? Short interest. Are people betting against the stock?
Very little sign of that. Short interest is really low, around 1.81% to 1.84% of the float.
And days to cover?
Also low, like 2.2 to 3.0 days. It means there's no big concentrated bet being placed against AAR by sophisticated short sellers. That lack of short interest is generally a positive sign.
And technically, how's the stock trading relative to its moving averages?
That tells an interesting story, actually. Right now, AAR is trading significantly above its 50-day moving average, which sits around $58.55. That signals strong, positive, near-term momentum.
And the longer-term 200-day?
Comfortably above that, too. The 200-day is around $62.82. The stock took a sharp dip back in late March, but it recovered strongly and crossed back above that key 200-day level in early June.
So technically, that looks bullish, like a turnaround.
Yeah, technically, it suggests the market's perception might be shifting, moving away from seeing it as a troubled company and more towards a turnaround story. The price action supports that narrative shift.
Interesting. Okay, so analysts are bullish, shorts aren't interested, and the chart looks positive. Now, who actually owns the stock? What does the ownership structure tell us? Chapter 5. Ownership structure.
Well, the first thing that jumps out is the institutional ownership. It's very high. Somewhere between 91% and 95% of all outstanding shares are held by institutions.
91 to 95%. Wow. That's a huge vote of confidence from the professional investment community, isn't it?
It certainly indicates significant trust. The top holders are the names you'd expect: BlackRock, Vanguard, Dimensional Fund Advisors, State Street, also Westwood Holdings.
So the big players are involved. Are they all adding to their positions?
Not uniformly. There's actually a bit of active debate happening. You see some index tracking funds like Dimensional and State Street have trimmed their positions slightly. But interestingly, you also have sophisticated active managers like Westwood and another one called Ophir Asset Management, who have been significant buyers recently.
So while not unanimous, having active managers known for deep research buying in is a pretty strong signal.
It's definitely a vote of confidence, yes. But now we come to the insiders.
What about management and board ownership?
That's relatively low, somewhere in the range of 2.3% to maybe 4.1%.
Okay, not insignificant, but not huge either.
But here's the critical point, and honestly, it's a significant red flag you have to consider.
Okay.
There has been consistent and pretty significant selling by top executives. And crucially, A complete absence of any open market purchases by insiders.
Selling, like who and how much?
Well, the CEO, John M. Holmes, he sold about $1.3 million worth quite recently. And over the last year, his sales total nearly $9 million.
9 million, wow.
Yeah. And other top executives have also sold millions of dollars worth of stock over the past year or so.
So what does that mean? If the stock is potentially undervalued, why are the people running the company selling, not buying?
That's the million-dollar question, isn't it? It definitely raises questions about their own conviction in the stock's potential for significant appreciation, at least in the near term. It contrasts sharply with the bullish analysts' views and the potential valuation gap we discussed. It's something investors really need to weigh up.
The definite red flag to consider. What about ownership concentration? Is there one dominant shareholder?
No, it's relatively diffuse, actually. The Herfindahl-Hirschman Index, the HHI, is low around 5.86%. Meaning ownership is spread out among many different institutions. Yeah. There isn't one single large shareholder who could drastically impact the stock price by suddenly selling a huge block. That diffusion reduces that specific type of risk.
Okay, got it. High institutional ownership, but concerning insider selling. Now let's bring together the good and the bad. What are the biggest risks facing AAR and its biggest opportunities? Chapter 6.
Risk assessment.
All right, let's use a classic SWOT framework here. Starting with strengths, we've covered these, but to recap, their deep 70-year aftermarket expertise is huge. Strong OEM partnerships with those exclusive deals. Their leading position in USM gives them a real cost and availability edge. The diversified business model, commercial, government, parts repair adds resilience. And that growing IP portfolio, especially tracks and their PMA parts.
Okay, clear strengths. Now, the weaknesses. The big one seems to be the balance sheet, right? High financial leverage.
Definitely. That 1.41 debt to equity over 3.0x net leverage. It makes them sensitive to interest rate hikes and economic downturns. Then there's the reputational damage from the FCPA settlement. Even though resolved, it's a weakness.
And that insider situation. Yes. Low insider ownership, combined with that recent heavy selling, raises questions about management conviction. That's a weakness in perception, at least. And finally, integration risk. Successfully merging that big Triumph acquisition isn't a given.
It makes sense. So, moving to opportunities, the industry tailwinds seem like the major one.
Massive opportunity there. That aging global fleet, the huge OEM backlogs, it creates this multi-year runway for growth in their core aftermarket business. It's hard to overstate how significant that is.
And they're building capacity to capture it.
Right. That 15% MRO network capacity increase by FY26 is timed perfectly. Plus, there are opportunities for cross-selling synergies, getting track software customers to use their MRO services, and vice versa, building that ecosystem. And the overall trend towards using more cost-effective USM parts plays right into their strengths.
Okay. And finally, the threats. What external factors could derail things?
Well, the usual suspects for this industry. Persistent supply chain and labor constraints could still hamper their operations, even if they benefit from others' constraints. An economic downturn, if severe enough to significantly reduce air travel, would eventually impact MRO demand, though it's less cyclical than new plane sales.
Geopolitical instability, too.
Yeah, always a threat. Could disrupt commercial travel, mess up supply chains further. Though it might potentially boost their defense side, it's usually a net negative for the broader business.
How do specific macroeconomic factors play in? Inflation, interest rates.
Inflation is really a double-edged sword for them. It increases their own costs, labor, parts they buy, but it also makes brand new OEM parts even more expensive.
Which makes AAR's cheaper USM and repair options look even better.
Exactly. So inflation could actually boost demand for their core offerings. Interest rates, though, are more of a straightforward threat because of their high debt load. Higher rates mean higher interest expense, hitting their bottom line and free cash flow directly.
Got it. What about something specific, like those U.S.-imposed tariffs mentioned for 2025? How would that impact a global player like AAR?
That's a significant and, frankly, unpredictable threat. AAR relies on complex global supply chains for parts, both buying and selling. Tariffs could increase their input costs, create massive uncertainty, disrupt the whole value chain.
Could it boost domestic repair demand?
Potentially, yes, if foreign options become prohibitively expensive. But overall, the disruption and uncertainty from widespread tariffs would likely be a major headwind. It's a real wild card.
Okay, we have covered a lot of ground today. Business, management, financials, market view, risks. Let's try and synthesize all of this and bring it to a conclusion. Chapter 7, conclude.
All right, synthesizing it all. The bull case for AAR, I think, rests on it being a classic pick and shovel play on these incredibly powerful multi-year tailwinds, the OEM backlogs, the aging fleet. The demand for what they do is structurally strong. Plus, management seems to be executing a clear strategic shift toward higher margin, more IP-driven businesses like Trax. And they do have a solid competitive moat built on scale, those exclusive deals, and deep expertise.
And crucially, that significant valuation disconnect we talked about, the idea that the stock is trading at a substantial discount to its estimated intrinsic value, suggesting the market is maybe too focused on the temporary gap losses, the debt, the legacy stuff.
While ignoring the strong core business and the long-term cash generation potential baked into those industry tailwinds, that's the heart of the bull case.
Okay, now the bear case. What are the main arguments against AAR?
The primary risks really center on that balance sheet. The high debt makes them vulnerable to rising interest rates or an economic slowdown. There's also execution risk. Can they successfully integrate Triumph and deliver the expected synergies?
And that insider selling.
For me, that's the most glaring red flag. That consistent, significant selling by top execs with zero open market buying. It really does raise questions about their own belief in a major stock price increase soon. You just can't ignore that.
Plus the FCPA shadow, even if resolved.
Yeah, it's a reputational stain. It highlights past weaknesses and means they need ongoing vigilance to ensure compliance, which carries its own costs and risks.
So let's just quickly restate the valuation summary the DCF models pointed to.
An estimated intrinsic value range, purely for educational purposes, of approximately $90 to $120 per share.
Okay. Again, an estimate, not a target, but it highlights that potential gap.
So wrapping up the outlook. AR's current share price, around $68.63, is trading at a pretty substantial discount to that estimated intrinsic value range. That discount seems to reflect the market pricing in those very real, tangible risks we discussed. The financial leverage, the insider selling, the execution risk on acquisitions.
So the final question for an investor looking at AAR Corp today is really one of conviction, isn't it?
Exactly. It boils down to this. Do you believe the powerful operational tailwinds, the strong competitive position, and the management team's strategic plan will ultimately win out over those significant financial and reputational risks?
If you're a bull, you see the current price as a compelling entry point into a long-term value story, driven by those undeniable industry trends.
But if you're a bear, you worry that the weight of the debt, or any missteps in execution, or maybe just management not having strong conviction themselves, could ground the stock's potential ascent. It's a classic risk-reward calculation.
A fascinating case study. And that concludes our deep dive into AAR Corp. Hopefully that's given you a lot to think about, connecting those industry trends, management moves, financials, and ultimately the underlying value proposition. And hey, remember, if you found this deep dive valuable, please do hit that like button and subscribe to the Stock Analytics AI YouTube channel. For just $4.99 a month, members get priority deep dives on tickers you suggest. Just add your stock ideas in the comments. We'd love to analyze what you're interested in.
And of course, the important disclaimer, this analysis was generated by an AI system. It's for educational purposes only. It should absolutely not be considered financial advice. Please always do your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Great reminder. Thank you for joining us on the deep dive. Until next time, keep digging for those insights.